Most people grow up believing financial power lives in visible places, in parliaments, Congress halls, ministries of finance. We are trained to think that laws shape markets and elections determine economic outcomes. Yet history quietly suggests something more uncomfortable. Again and again, true power reveals itself not through speeches, but through the quiet ability to decide who gets money when trust disappears. Long before central banks became household names, this power was learned the hard way, during moments when systems failed and someone had to act. This story begins not with scandal, ideology, or accusation, but with absence. The absence of structure, the absence of authority, and the slow rise of a private institution that learned how to fill that void before governments knew how to. In October 1907, New York City stood on the edge of financial paralysis. The panic did not begin with a dramatic announcement or a single catastrophic event. It began quietly, as most financial crises do, with leverage and overconfidence. A failed attempt by speculators to corner the copper market unraveled trust in several institutions connected to it. Trust companies, which operated with far thinner reserves than traditional banks, suddenly faced withdrawal demands they could not meet. When the Knickerbocker Trust Company closed its doors, fear spread faster than facts. Depositors rushed from one institution to the next, converting uncertainty into collapse. Call money rates spiked violently. Brokers on the New York Stock Exchange faced the real possibility that trading would halt altogether, not because prices were falling, but because liquidity had vanished. At that moment, the United States had no Federal Reserve, no centralized authority capable of injecting liquidity into the system. The Treasury Department was limited, slow, and distant. Washington could observe events, but it could not manage them in real time. The American financial system, as it existed in 1907, was fragmented by design. That design choice traced back decades earlier to the destruction of the Second Bank of the United States in 1836. When President Andrew Jackson dismantled that institution, the decision was celebrated as a victory for democracy and decentralization. Centralized financial authority was seen as dangerous, elitist, and incompatible with American values. Credit was intentionally dispersed among thousands of private banks, each responsible for its own survival. For a time, that fragmentation appeared to work. As the economy expanded westward and industrialized through the mid-19th century, growth masked structural weaknesses. But with each passing decade, the cost of decentralization became clearer. Financial panic struck with unsettling regularity. In 1857, a collapse in railroad securities triggered a sharp contraction. In 1873, overinvestment in speculative excess brought another crisis that lingered for years. In 1893, yet another panic ripped through the economy, producing widespread unemployment and business failures. Each time, the pattern was the same. In good times, decentralization encouraged risk-taking. In bad times, the system froze. Banks hoarded reserves, interest rates spiked, and credit disappeared precisely when it was needed most. What the United States lacked was a lender of last resort, an institution capable of stepping in during moments of panic to stabilize interest rates and restore confidence. In Europe, this problem had been addressed earlier. The Bank of England, established in 1694, had gradually evolved into such a stabilizing force. It absorbed shocks, managed reserves, and moderated interest through coordinated policy. American policymakers, wary of concentrated power, had rejected this model. But markets do not tolerate vacuums indefinitely. When public institutions refuse to provide coordination, private ones often emerge to fill the gap. This is where the House of Morgan enters the story. John Pierpont Morgan was not simply an American banker. He was the product of an international financial education. Born in 1837, Morgan was trained in Europe, studying in London and Paris at a time when merchant banking had already learned the importance of discipline, reserves, and coordination.
His father's firm, J.S. Morgan and Company, operated as a transatlantic bridge, channeling European capital into American industry. Railroads, steel, and infrastructure projects flowed through Morgan syndicates. More importantly, Morgan absorbed a deeper lesson from Europe. Interest was not just a price, it was a signal. Managed properly, it stabilized behavior. Mishandled, it fueled panic. By the 1870s and 1880s, Morgan's influence extended far beyond ordinary banking. After the Panic of 1873, he pioneered a new approach to corporate finance. Failed railroads were not allowed to simply collapse. Instead, they were reorganized. Morgan and his partners consolidated debts, adjusted interest schedules, replaced management, and imposed financial discipline. These restructurings were not primarily about profit maximization in the short term. They were about restoring order in an environment where disorder had become systemic. Each successful reorganization reinforced trust in Morgan's ability to manage crises. Over time, market participants learned an implicit lesson. When Morgan was involved, outcomes were more predictable. This process quietly reshaped the American financial system. Banks, trusts, and corporations increasingly depended on a small number of powerful intermediaries for access to capital. The system was not centralized by law, but by necessity. Morgan did not control markets in a mechanical sense. What he controlled was coordination. In times of stress, he could bring competing institutions into the same room, align incentives, and pool resources. Interest rates, which might otherwise spike chaotically, were stabilized through collective action. This reduced volatility and restored confidence, but it also concentrated influence. By the early 20th century, the House of Morgan had become something unprecedented in American life. It was not a government agency. It held no formal political authority. But in moments of financial distress, it functioned as an unofficial central bank. This reality became impossible to ignore during the Panic of 1907. As markets convulsed and liquidity vanished, Morgan summoned leading bankers to his library on Madison Avenue. There, far from the public eye, decisions were made that would determine which institutions survived and which failed. Capital was pooled, support was extended selectively, interest rates were negotiated overnight. When the New York Stock Exchange reopened, it did so not because Congress acted, but because private coordination restored trust. The success of this intervention exposed a profound contradiction. On the one hand, it prevented a complete financial collapse. On the other, it made the system dependent on one individual and one private institution. Policymakers recognized the danger immediately. Stability had been achieved, but at the cost of democratic accountability. What would happen when Morgan was gone? Could a modern economy rely indefinitely on private crisis management rooted in personal authority? The response was not immediate, but it was decisive. In the years following 1907, Congress established the National Monetary Commission, led by Senator Nelson Aldrich. The commission studied European central banks, particularly the Bank of England and the German Reichsbank. Its conclusion was clear. The United States needed an institution capable of doing publicly what Morgan did privately, managing reserves, stabilizing interest rates, and acting as a lender of last resort. When the Federal Reserve Act was passed in 1913, it marked a fundamental transformation. The techniques Morgan perfected during decades of crisis management were institutionalized within a public framework. This transition did not eliminate concentration, it formalized it. Power shifted from individual bankers to institutions, but the underlying logic remained unchanged.
Stability required central coordination. Interest became a policy tool rather than a market accident. Over time, the Federal Reserve assumed responsibilities once handled informally by private bankers. Liquidity provision, emergency lending, and interest rate management became permanent features of the system, not temporary solutions. The long-term consequences were profound. Financial cycles became less frequent. But when they occurred, they were larger in scale. Access to cheap credit encouraged expansion, leverage, and innovation. It also encouraged risk-taking and asset inflation. Smaller institutions increasingly depended on centralized mechanisms. The system grew more efficient, but also more interconnected. This interconnection increased both stability and fragility. Shocks were absorbed more smoothly, but failures could propagate systemically. Seen in historical context, the House of Morgan did not seize power from the state. It demonstrated what happens when the state declines to organize financial stability. Markets do not remain neutral. They reorganize around those capable of managing risk. The evolution of interest from a market price to a policy instrument reflects this reality. Interest came to represent trust in the system itself. When trust was high, rates fell. When trust collapsed, coordination became essential. This pattern is not unique to the United States. The Bank of England followed a similar path after repeated crises in the 18th and 19th centuries. Modern financial systems across the world revealed the same sequence. Fragmentation produces instability. Crises force consolidation. Institutions emerge to manage risk. Over time, these institutions become central nodes of power, whether public or private. Changing such systems is difficult because they reward stability over fairness. Once built, they resist reform, not because of conspiracy, but because incentives align around preserving order. History suggests that financial structures rarely disappear. They evolve, adapting old lessons to new circumstances. The legacy of the House of Morgan lives on not in family dominance, but in the architecture of modern central banking. Understanding this history sharpens how we interpret the present. Central banks did not appear suddenly. They were shaped by private experimentation during periods of failure. Interest policy is not arbitrary. It reflects centuries of attempts to balance growth, stability, and trust. The story of Morgan is not about secret control. It is about systems responding to weakness and power flowing toward those who could manage chaos when others could not. If there is one lesson to carry forward, it is this: financial power rarely announces itself. It reveals itself during crises, when decisions must be made quickly and coordination matters most. By studying how figures like Morgan operated within flawed systems, we gain clarity about our own. And clarity, in finance as in history, is one of the few advantages that endures. History is not just a record of what happened. It's a map of why power moved the way it did. If this story helped you see finance not as noise, but as a system shaped by time, incentives, and human decision-making, then you're already thinking differently from most. If you believe more people deserve this clarity, support this work. Subscribe to History of Finance Decoded. Share this episode with someone who values evidence over assumptions. Every like, every share, every subscription helps us continue uncovering historically grounded stories about money, power, and the ideas that quietly shaped the modern world. Until next time, stay curious and stay informed.